Wars by their nature are inflationary, as goods requiring raw materials are produced and then destroyed without an increase in productive capacity. They're also a bad time for cash, since governments keep financing costs low. Cash is the worst asset, as seen in US 35 to 40. And here's that chart for anybody who can't see it. So let's talk about that.
Yeah, well, basically what happens during a war, right, is that you create materials and then you destroy them through the course of pursuing a conflict. And that by its nature is inflationary because typically when you invest or you build things, you're doing it to increase future productive capacity. And in a war, you're essentially destroying productive capacity and using those raw materials. So you get that squeeze and you get that rise in inflation. The same thing is happening. The same thing at the same time, what's happening is that governments need to finance the war effort and almost always keep interest rates artificially low relative to those price rises in order to essentially socialize the cost of the war financing to the entire economy through the tax that is inflation. And so basically what you see is holding cash is a particularly bad asset because not only is the yield a lot lower than it should be during normal times, but also inflation is elevated. You put those two things together, and while cash may feel safe during a conflict environment, it actually has a significant erosion of purchasing power.
Right. And here's the bond real return, as you've showed here, also from 35 to 40, 50. So basically, I mean, most of the examples you're giving here are based on World War II, correct?
Yeah, I think
that's sort of the base case.
World War II, I would say, is obviously the most extreme international conflict that we've seen, in the last, since the 1700s. And so I think it's useful not to say that necessarily these are the exact price dynamics that we'll experience, but it is useful to understand how the linkages work, right? How the dynamics work. And I wrote this, as a simple example, I wrote this, right on the Monday after the Hamas terrorist activities in Israel. And, if you look at how things have played out since that point, like gold is up, bonds have sold off, right? Stocks haven't done very well. Not nearly as extreme as what's presented here, but it's the conflict itself on a global perspective is smaller, as well as the fact that it's been shorter in duration. So I think these things are useful. On the bond side, just an important thing to highlight is just how when you have increased war efforts, you have increased government financing. And so they have to issue a lot of bonds. And again, both on the short end and on the long end, they depress yields, usually by fixing yields in one form or another as bonds are issued during that wartime to socialize the costs as well.
What I find so fascinating is that, yes, we have the example now of Hamas and Israel, but we also just had the debt ceiling lifted when we had 31 trillion in debt, and now we're over 33. So the government is already doing this, right? We obviously often talk here about the difference between monetary policy that people fixate on and fiscal policy when it comes to the Treasury. But we're effectively already doing this without being in wartime, right?
That's
We're issuing trillions of dollars in bonds. We know that there's less demand for those than there historically was. In fact, they're even selling off, as you said. So we're already seeing this without even having the conflict.
That's right. I mean, we're running recession-like deficits at a time when the unemployment rate is at 50 or 75-year lows, and so that is an unusual circumstance and suggests a level of fiscal expansionary fiscal policy that is unusual, to say the least, at a time when the economy is doing reasonably well, all things considered.